The current economic landscape. The US economy is at a critical juncture. Amid rising concerns about inflation, unemployment, and economic growth, the Federal Reserve has taken decisive action by cutting interest rates by 50 basis points. This move marks the first such cut in over 4 years and has raised eyebrows across the financial world. Investors, economists, and policymakers alike are debating the implications of this decision. While some see it as a necessary step to stimulate a slowing economy, others fear it could signal the beginning of a more significant downturn. The debate centers on whether this rate cut is a preemptive strike to avoid recession or a reaction to underlying economic troubles that are yet to fully surface. Understanding the reasons behind this move, its potential impacts, and how it fits into the broader economic narrative is essential as we navigate the months ahead. Economic tension and rate cuts. The Fed's decision, a response to economic tensions. At the core of the Federal Reserve's recent rate cut is a growing tension between key economic indicators. On the one hand, unemployment remains low, but there are signs that the labor market may be cooling. On the other hand, corporate earnings have shown signs of contraction, raising concerns about the health of the business sector. This duality creates a delicate balancing act for the Fed, as it seeks to promote growth without exacerbating inflation or triggering a downturn. By cutting rates, the Fed hopes to stimulate economic activity by making borrowing cheaper for businesses and consumers. However, the decision to cut by 50 basis points, rather than a more modest 25 basis points, suggests that the Fed sees more significant risks on the horizon. A stimulus for growth. Why 2 to 3% by 2026? Looking ahead, many analysts believe that the Federal Reserve will continue to lower rates, possibly bringing them down to 2 to 3% by the end of 2026. This projection is based on the need to stimulate the economy in the face of mounting global and domestic pressures. The US economy has been hit by multiple shocks over the past few years, from the COVID-19 pandemic to supply chain disruptions and geopolitical tensions. In such a climate, the Fed's primary tool for managing economic growth is adjusting interest rates. A prolonged period of low rates could help ease the pressure on businesses, encourage investment, and support consumer spending. However, there is also the risk that these actions could lead to unintended consequences, such as asset bubbles or further inflationary pressures down the road. To fully understand the significance of the current rate cut, it is important to look at historical precedents. There have only been 3 instances in modern US economic history when the Federal Reserve initiated a 50 basis point rate cut: the 2001 dot-com bubble burst, the 2007 Great Financial Crisis, and the 2020 COVID-19 pandemic. Each of these periods was characterized by severe economic stress, and the rate cuts were part of broader efforts to stabilize the economy. In 2001, the rate cut followed the collapse of many technology stocks and a sharp decline in corporate investments. The 2007 cut came as the housing market crashed, leading to a global financial meltdown. In 2020, the pandemic forced economies around the world to shut down, leading to an unprecedented contraction in economic activity. In each case, the rate cut was an acknowledgement of the severity of the crisis, and in each case, the economy faced a prolonged recovery period. While the current economic situation is not identical to those previous crises, there are parallels that cannot be ignored. Today's concerns revolve around inflation, a tightening labor market, and geopolitical instability. The fact that the Federal Reserve has chosen to start with such an aggressive rate cut suggests that they see significant risks ahead. This has led some to speculate that a recession may be looming, even if it has not yet fully materialized. It is worth noting that in both 2001 and 2007, the economy officially entered a recession shortly after the rate cut cycles began. Whether the current situation will follow a similar trajectory remains to be seen, but the historical context is certainly cause for concern. Market reaction and future rate cuts. Investor concerns and market volatility. The financial markets have reacted with a mix of apprehension and uncertainty to the Federal Reserve's recent actions. Many investors had expected a more modest 25 basis point cut and were caught off guard by the larger than anticipated reduction. This has led to increased market volatility as traders try to interpret what the Fed's decision means for the future of the economy. Some view the aggressive cut as a sign that the Federal Reserve is in panic mode, attempting to get ahead of worsening economic conditions. Others see it as a necessary and proactive step to prevent a more serious downturn. Regardless of the interpretation, the rate cut has created an atmosphere of uncertainty, with investors unsure of what to expect in the coming months. Predictions for further cuts and quantitative easing. Looking ahead, many experts believe that the Federal Reserve will continue to lower rates over the next year. Some forecasts suggest that rates could drop by another 50 basis points before the end of 2024, bringing them closer to historical lows. There is also growing speculation that the Fed may restart its quantitative easing, or QE program, which involves purchasing government bonds and other securities to inject liquidity into the financial system. QE was a key tool used during the 2008 financial crisis, and again during the pandemic. If the Fed does decide to restart this program, it would signal that they are deeply concerned about the health of the economy. However, such measures also come with risks, particularly in terms of inflation and asset bubbles. The yield curve and recession indicators. A. The yield curve inversion, a warning sign. One of the most reliable predictors of a recession is the yield curve inversion, a phenomenon that occurs when short-term interest rates rise above long-term rates. Historically, yield curve inversions have preceded nearly every US recession in the past 50 years. The logic behind this indicator is that investors typically demand higher returns for longer-term investments due to the higher risks involved. When short-term rates exceed long-term rates, it suggests that investors are losing confidence in the economy's long-term prospects. The yield curve has recently inverted, and this has sparked widespread concern that a recession may be on the horizon. While the exact timing of a potential downturn is uncertain, the inversion has added another layer of anxiety to the already volatile economic landscape. De-inversion and its implications. Interestingly, recessions typically occur not when the yield curve first inverts, but when it subsequently de-inverts. This de-inversion happens when the Federal Reserve starts cutting short-term rates in response to signs of economic weakness. In many ways, the recent rate cut can be seen as part of this process. The Fed has raised short-term rates aggressively over the past 2 years to combat inflation, but as the economy shows signs of cooling, they are now reversing course. The question is whether the Fed's actions will be enough to avoid a recession, or if the economy is already too far along the path to contraction. Some experts believe that the rate cuts will help achieve a soft landing, where the economy slows down without falling into a full-blown recession. Others, however, are less optimistic. AI and technological disruption. The impact of AI on the workforce. While the Federal Reserve's actions dominate the headlines, another major force shaping the economy is technological innovation, particularly in the field of artificial intelligence, or AI. Over the past few years, AI has made rapid advancements, and its impact on industries such as customer service, healthcare, and finance is already being felt. One of the most significant disruptions is expected in the realm of customer support, where AI is increasingly being used to automate routine tasks and provide more efficient service. Technologies like large language models and voice recognition are now capable of handling many of the tasks that were once performed by human workers. As a result, companies are investing heavily in AI, and this is likely to lead to significant job displacement in the coming years. AI as a deflationary force in the economy. Beyond its impact on specific industries, AI is also expected to play a broader role in shaping the global economy. Some experts, including Raoul Pal, believe that AI is a fundamentally deflationary technology. As AI systems become more efficient and capable, the cost of producing goods and services is expected to fall dramatically. This, in turn, could help counteract inflationary pressures and increase productivity across the economy. In addition to AI, other disruptive technologies such as robotics and renewable energy are likely to contribute to this deflationary trend. While these changes will undoubtedly create challenges, particularly in terms of job displacement, they also offer the potential for significant economic growth and innovation in the years to come. Conclusion: preparing for an uncertain future. As the US economy enters a period of uncertainty, both in terms of monetary policy and technological disruption, it is clear that we are at a pivotal moment. The Federal Reserve's decision to cut rates by 50 basis points has raised important questions about the future of the economy and whether we are headed for a recession or merely a slowdown. At the same time, the rise of AI and other technologies is creating new opportunities and challenges for businesses and workers alike. The coming months will likely be marked by increased volatility, both in the markets and in the broader economy. For investors, businesses, and policymakers, staying informed and adaptable will be key to navigating this uncertain future.